A growing financial concern is quietly affecting thousands of Canadian retirees from coast to coast. According to tax experts and financial analysts, many seniors across the country are failing to claim credits and benefits they have rightfully earned, resulting in potential losses that could reach several $1,000s annually. The figure generating significant discussion among retirement planners and tax professionals stands at $7,411, representing the approximate value that eligible seniors could recover through proper application of existing tax provisions and benefit protections. Investigators examining the Canadian retirement income system have discovered that the issue does not stem from fraudulent activity or deliberate evasion. Instead, the problem appears rooted in a fundamental lack of awareness about how federal and provincial tax mechanisms interact with retirement income sources. Financial professionals report that countless seniors simply do not understand the full scope of credits available to them under current legislation. For Canadians currently receiving Canada Pension Plan payments, old age security benefits, or income from registered retirement funds, these findings carry significant implications. The difference between understanding the system and remaining unaware could translate to thousands of dollars retained or lost over the course of retirement. Government data confirms that the Canadian tax framework contains multiple provisions specifically designed to reduce the financial burden on older citizens. These measures were implemented to recognize the unique circumstances facing retirees who depend primarily on fixed income sources. However, the responsibility for claiming these benefits ultimately rests with individual taxpayers rather than automatic government intervention. The foundation of tax relief for all Canadians begins with what authorities call the basic personal amount. This provision allows every taxpayer to earn income up to approximately $16,000 annually before federal income tax applies. For individuals living exclusively on modest retirement income, this credit alone can eliminate federal tax obligations entirely. However, the system extends considerably further for citizens who have reached the age of 65. Upon reaching this milestone, Canadian seniors become eligible for an additional federal provision known as the Age Amount Credit. Tax authorities designed this credit explicitly to provide enhanced relief for older Canadians navigating retirement on limited resources. Current regulations allow the age amount to deliver thousands of dollars in additional tax reduction for qualifying individuals. Financial analysts note that when combined with the basic personal amount, seniors can effectively shield a substantial portion of their retirement income from federal taxation. Yet investigators have identified a critical detail that frequently escapes public attention. The age amount credit does not remain constant regardless of income level. Instead, the credit begins reducing once annual income surpasses a designated threshold. This reduction mechanism means that seniors with identical total incomes may experience dramatically different tax outcomes depending on how their income is structured and reported. The complexity increases further when examining pension income provisions. Canadian tax law provides an additional credit called the pension income amount for retirees receiving eligible pension payments. This provision allows up to $2,000 of qualifying pension income to receive preferential tax treatment, effectively reducing the tax burden on these funds. When tax professionals calculate the combined effect of these three credits, the basic personal amount, the age amount, and the pension income amount, the potential reduction in federal tax liability becomes substantial. Provincial tax systems add another layer of credits that can further decrease obligations to government. Financial experts examining multiple scenarios have determined that the total reduction can approach several $1,000s annually when all provisions align correctly. This calculation forms the basis for the $7,411 figure that has captured attention across retirement planning circles. However, authorities emphasize an important caveat that all Canadian seniors should understand. These benefits do not automatically apply in optimal fashion without active participation from the taxpayer. The Canada Revenue Agency administers tax law but does not proactively review individual returns to ensure maximum credit utilization. That responsibility falls squarely on citizens or their designated tax preparers. A separate concern weighing on many Canadian retirees involves what officials term the Old Age Security Recovery Tax, commonly referenced as the OAS clawback. This provision affects seniors whose annual net income exceeds established thresholds, currently set slightly above $90,000. When income surpasses this level, the government requires repayment of a portion of old age security benefits through the tax system. The repayment amount increases proportionally as income rises further above the threshold, potentially eliminating OAS payments entirely for high income recipients. Tax investigators point to a critical detail that frequently causes confusion among affected seniors. The clawback calculation relies on net income as reported to federal authorities rather than gross earnings. This distinction means that proper application of deductions and credits can influence whether the clawback triggers and at what level. For retirees whose income hovers near the threshold, even modest adjustments to income reporting structure can produce meaningful differences. Financial advisors report that many clients remain unaware that available credits could reduce their reported net income sufficiently to preserve old age security benefits. Another underutilized strategy that tax professionals believe could benefit thousands of Canadian couples involves pension income splitting provisions. Current regulations permit married couples or common law partners to reallocate eligible pension income between spouses for tax purposes. Specifically, couples may transfer up to 50% of qualifying pension income from a higher earning spouse to a lower earning partner. This reallocation occurs only for tax reporting purposes and does not require physical movement of funds between accounts. The strategic advantage becomes apparent when examining graduated tax brackets. By distributing income more evenly between partners, couples can potentially reduce their combined tax burden significantly. In some circumstances, this approach helps preserve eligibility for income-tested credits, including the age amount. Financial planners also note that pension splitting can sometimes keep one partner below the old age security clawback threshold, effectively protecting benefits that would otherwise require repayment. The formal mechanism for electing this treatment involves filing Form T-1032 jointly with both partners' annual tax returns. Despite these potential advantages, industry surveys suggest that many eligible couples have never considered whether pension splitting could reduce their household tax obligations. Advisors attribute this gap to limited public awareness about the provision's existence and application. The tax-free savings account represents another powerful tool that retirement specialists believe remains underutilized among Canadian seniors. Since its introduction, the TFSA has offered unique advantages that become particularly valuable during retirement years. Investment income generated within these accounts, whether from interest, dividends, or capital gains, remains entirely excluded from taxable income calculations. This treatment means that growth occurring inside the account creates no additional tax liability regardless of amount. For seniors concerned about old age security clawback provisions, the TFSA offers an additional strategic benefit. Income earned within these accounts does not factor into the net income calculation that determines whether OAS repayment applies. Consequently, investments held inside a TFSA produce returns without pushing reported income toward clawback thresholds. Financial analysts suggest that seniors approaching the OAS income threshold should consider whether relocating certain investments into tax-free savings accounts could help maintain reported income below triggering levels. Many Canadians have accumulated considerable contribution room over the years, particularly those who did not maximize deposits when the program first became available. Authorities confirm that available contribution space varies based on individual circumstances and accumulates annually for eligible residents. For long-term eligible individuals who have not previously contributed, the available room may represent a substantial opportunity for tax-efficient investment positioning. Retirement income specialists emphasize that financial circumstances do not remain static after benefits commence. Registered retirement income fund withdrawals increase automatically with age due to mandatory minimum distribution requirements. Investment returns fluctuate based on market conditions. Pension payments may adjust periodically for inflation. Simultaneously, government thresholds and credit calculations undergo regular revision. Tax professionals warn that a return filed correctly several years ago may not reflect optimal strategy under current rules and personal circumstances. This reality leads to what industry observers identify as the most prevalent issue affecting Canadian retirees, a pattern they describe as passive filing. This approach involves submitting tax returns without actively reviewing whether all available credits and strategic options have been properly considered. Many seniors rely exclusively on automated tax preparation software or simply replicate previous year filing patterns. While such software provides valuable assistance, it functions only with information users provide. If certain elections or strategies go unconsidered during preparation, the software cannot independently identify missed opportunities. Canadian tax authorities provide some recourse for historical oversights. Regulations generally permit individuals to request adjustments to previously filed returns for up to 10 years. When credits were incorrectly omitted or calculations contained errors, reassessment requests may recover previously forfeited amounts. Tax professionals advise seniors seeking to evaluate their situation to begin by examining their most recent notice of assessment. This document summarizes the outcome of the last filed return and confirms which credits the government applied. Two entries merit particular attention from senior taxpayers. The age amount credit line indicates whether this provision was applied and at what level. The pension income amount line reveals whether eligible pension credits were properly claimed. Verification of these entries provides initial insight into whether available tax reductions were fully captured. Couples should additionally review whether pension income splitting received consideration. When significant disparity exists between spousal pension incomes, comparison calculations can reveal whether reallocation would reduce combined household obligations. Reviewing tax-free savings account contribution room represents another valuable exercise. The Canada Revenue Agency provides this information through its online portal, allowing individuals to determine available space for potential tax-efficient investment repositioning. Financial authorities consistently emphasize that individual circumstances vary considerably. Provincial residence, marital status, total income composition, and available savings all influence final outcomes. Universal recommendations cannot account for these personal variables. The essential takeaway involves awareness rather than specific action. The Canadian Retirement Income Framework includes numerous built-in protections intended to help seniors maintain financial security following decades of workforce participation and contribution. These protections deliver maximum value only when individuals understand how rules apply to their particular circumstances. For Canadians currently receiving Canada Pension Plan or Old Age Security payments, or those anticipating benefits soon, annual review of tax positioning can yield substantial long-term advantages. Even modest improvements compound significantly over retirement years. Retirement income represents accumulated lifetime effort for most Canadians. During retirement, every dollar retained contributes to stability and independence. Ensuring proper application of available tax credits and strategic options helps protect that income within existing legal frameworks. The interaction between benefit programs, tax credits, and investment account structures may initially appear complicated. However, once the fundamental relationships become clear, many seniors discover that the system provides more support than they previously recognized. The critical perspective shift involves abandoning assumptions that optimization occurs automatically, asking questions, reviewing official assessments, and periodically consulting qualified tax professionals helps ensure retirement income operates as efficiently as possible under current legislation. The figure referenced throughout this report, $7,411, does not represent a guaranteed payment or universal entitlement. Rather, it illustrates the magnitude of potential tax reduction that can occur when multiple credits and strategic provisions combine correctly. Individual amounts will vary based on personal circumstances. Some seniors may realize smaller benefits, while others could achieve larger savings. The fundamental point centers on understanding that Canadian tax law contains mechanisms specifically designed to reduce senior tax burdens and verifying whether those mechanisms are functioning fully in each individual case. The most impactful step any retiree can take involves maintaining informed awareness. Government policies evolve continuously, thresholds adjust periodically, personal income situations shift over time. Regular circumstance review ensures that hard-earned retirement income remains maximally protected under Canadian law. That awareness alone can produce significant financial differences throughout retirement years. For Canadian seniors navigating an increasingly complex financial landscape, understanding available protections represents not merely an opportunity, but an essential component of effective retirement planning.